Welcome back. Now it's time for top picks. And now your top pick, Brian, very much in focus. We're seeing that uranium rally take off over the last few days. Tell us, why is this one of your top picks?
Yeah, so the stock we're in question is Cameco. It's one of the world's largest producers of uranium. And crucially, it is among a very, very small number of publicly traded pure play uranium companies. What investors should realize is that 7 of the 10 largest uranium producers in the world are state-owned companies. You can't buy them. And then you've got companies like BHP, which are sort of polymetallic companies with a little bit of uranium in the mix. So if you want exposure to uranium, Cameco is generally speaking the go-to vehicle. They have 2 producing high-grade mines in Saskatchewan, and they've got a joint venture in Kazakhstan, an in-situ leaching mine. And across those mines and various other assets, they have about 450 million pounds of uranium reserves. And so what they are doing is they are ramping their McArthur River mine, which, if I'm not mistaken, is the world's largest high-grade uranium mine. They had been switched off and put on care and maintenance for years due to uranium prices being too low. But what's happening is utilities are increasingly scrambling to find fissile material for their reactors from safe, stable sources, i.e. not Russian uranium. And so Cameco is a logical and reliable counterparty. So they're switching that mine back on. The company is poised to triple its earnings next year versus this year on the back of that boosted production and rising uranium prices. So although the shares have rallied nicely, we do think there's more in store and are eager buyers of Cameco today.
Very interesting. And you're not alone in terms of your enthusiasm. Just quickly looking at the Bloomberg terminal, estimated PE right now is about 112 as well. So lots of interest in this business. Let's take a look at the next one. Among the big 6, TD Bank. Why does this one stick out for you?
Yeah, so this one doesn't trade at 112 times earnings. It's much less demanding multiple, but we do like this bank. It's been a great value creator among a whole host of great value creators in Canadian banking over the years. We think they won the beauty contest as far as their Q3 earnings results go. We saw the last of those results today with BMO reporting their numbers. Their U.S. division really did quite well. It's very net interest margin sensitive, so rising rates advantages that division, more than fully offsetting increasing credit loss provisions. Their Canadian business did very well. And capital markets, or the investment bank part of the business, which has been sort of a point of weakness or bone of contention across the sector, is relatively small for TD overall, so it didn't dilute the otherwise good results. And the big catalyst on the horizon, pardon the pun, is this First Horizons regional bank that they're poised to close on. Right. They say later this year. We think it might get dragged out into 2023, but it's a huge deal. $600+ million of synergies. We think they'll integrate it very capably, create a lot of value.
Wonderful. Let's go for your last pick. This is American Tower, New York Stock Exchange listed.
Right. So I sort of teased a caller earlier. There was going to be a real estate name. So this is the name. It's not industrial. It's not retail. It's not office. Very much specialty real estate play. This is a company that leases tower space to cell phone and broadcast carriers. So that's the secular growth opportunity for the company as network carriers increasingly deploy 5G gear across their networks. They need more space in the towers. There's geographic international expansion story here into emerging markets and places where they're building out capacity really quickly. They're protected well from inflation. A lot of this business is written on long-term service contracts with an inflation plus character to them. And then recently, the company got into another high-growth segment, which is data centers, with the acquisition of CoreSite Realty last year for about $10 billion. So overall, it's about a $120 billion company. Like most REITs, it pays a decent dividend, yields just over 2%. But it's actually a growth and income story, and it's created a total shareholder return of 350% over the last 10 years. So we think it's timely, and we think it's a longer-term winner as well.